you. Thank you so much. Absolutely delighted to be here today with the entire team. I realize it is Saturday evening. Truly appreciate your time with us this evening. Along with me on this call, I have Shanti and then Devang, our Group CFO, all the other members, management team. Today, actually, we have a pretty busy schedule. I think I thought we'd cover three important matters. Number one, Devang will walk us through the financial numbers, the quarter and the year. I hope you'll agree that they are pretty impressive numbers. Shanti will cover the highlights of the bank. And as a from the past, I'd like to shine the spotlight on one of our businesses. This quarter, we picked the capital markets business. This is something I do every quarter to give you a very good sense of the totality of the group. After the numbers, second agenda item, I do want to talk to you about the RBI order and its implications. And then three, I thought I'd share with you my broad level thinking on the strategy for the group going forward. As a management team, we've already spent a lot of time on this, and I think directionally where we are going, I'd like to share that with you today. Post that, of course, we'll open up for Q&A. And for starters, let's go to Devang and let Devang take us through the numbers. Devang, please.
Thank you, Ashok. Before I start the results, I would like to express my deep gratitude to Jaimin Bhatt for building this session on foundation of trust and transparency. I intend to carry forward this legacy and look forward to working with each of you. Let's start with the consolidated numbers first, which we disclosed earlier today. We entered this financial year with a profit of 18,230 crores. It is 22% higher than what we did in FY2023. Profit for the quarter at the consolidated level was 5,037 crores, which is about 17% higher than the last year. Our consolidated customer asset is about 4,79,000 crores, which is roughly 22% higher than last year. Our capital adequacy at group level, 21.80%, which includes CET1 itself of about 20.7%. We have redeemed preferential capital during the Q4. Our CET1 is pure equity. ROE at consolidated level of 15.08 and ROA at 0.66% for the full year. Starting with the bank, which contributes about 75% of our consolidated. For the full year, bank clocked PAT of 13,780 crore, up 26% over last year. This year, we added 90 lakh customers, of which 24 lakh customers added during the last quarter. At the bank standalone level 2, we have a capital adequacy now of 20.55 with CET1 of 19.25%. After bank clocked ROA of 2.97% with full year ROA of 2.61%. Bank customer assets by 20%, 4,23,000 crore annually, the Q4 growth of 6%. During Q4, we completed acquisition of Sonata Microfinance towards the end of March. Some info about Sonata. Sonata Microfinance is based out of Lucknow and has a branch network of about 110 branches in about 105 districts centered around UP, MP, Bihar, and North India. It actually complements with our earlier acquisition, which was largely based out of South. And you will see the results of Sonata into the next year's performance. Our CASA now at 45.5%. Total deposit for the year grew and YOY. The TD Sweep product we launched in May, growing at 100% YOY. Our growth continues to be challenging. NIM for the bank for full year 5.32%, almost same as last year, 5.28% for the Q4 24, up from 5.82 in Q3 on higher earning asset yields. Fees and services saw a robust growth of 25% in FY24 versus what we did a year ago. Operating costs increased by 21% compared to last year. We continue to spend about 10% of our total operating expenditure on information technology. Tax for Q4 24, 4,130 crore, up 38% compared to previous quarter with NII of 6,909 crores. This quarter we saw a favorable order with respect to income tax. This enabled us to reverse some tax provision of about 200 crores, besides interest on refunds. Q4 24 result also includes reversal of AIF provision of 157 crore. As you would have recalled, we had done 190 crore provision in the quarter, which now requires, this is based of course on RBI circular issued in March 24. Gross NPA is 31st March 1.39% and net NPA is 0.34, same as last quarter, and actually reduced from 0.37 last year. Credit cost for the year 5 basis. During Q4, bank wrote off fully provided retail unsecured loans aggregating to 1,460 crores. However, bank will continue to pursue collections from this accounts, and such write-off has no impact on results for the bank as they were fully provided. Our fund-based restructured advances under COVID MSME resolution framework currently are at 383 crore, which is about 0.10% of our advances. Our S2 at March 31 is fund-based borrowers with exposure of over 5 crore is about 199 crore. Let me now turn to the subsidiaries performance. Kotak Security and Kotak Capital perform exceedingly well with tailwinds from capital markets. Kotak Securities recorded 52% growth in profit to 1,226 crores, increase in market volume. Kotak Capital made profit of 215 crore, up 4% compared to last year, with increased activity in IPO and advisory space. As Ashok mentioned, we will have my colleagues from both these companies while in further detail later on this call. Kotak Investments, the NBFC profits increased by about 58% to rupees 515 crores, primarily due to growth in advances and increase in recoveries. Kotak Crime, which is involved in the car finance business, had a growth over last year. Profit is 888 crores. Last year profit included some reversal of provisions as well as income from bought out portfolios. Both Kotak Prime and Kotak Investments are well capitalized, and the capital adequacy of both of these companies is in excess of 25%. DSS Microfinance, this is the microfinance company, business content based out of Bangalore, ended the year with a post-tax profit of 380 crores as against 297 crores last year. Kotak Life continues to focus on balanced approach in its product channel mix towards building sustainable growth and value. The company's overall premium grew by 50%, while the individual premium saw a muted growth. The embedded value of Kotak Life at the end of the year was 6,240 crore, with growth of 31.6%. The value of new business, PNC as it is called, is 1,053 crore, a healthy margin of 28.5%. Kotak Life profitability impacted on a higher commission payout and strain in new business in non-products, and ended the year at a PAT of 639 crores. The company continues to have higher solvency ratio of 2.56 times as against regulatory requirement of 1.5. Kotak Life quality parameters continues to improve, conservation ratio moving to 88.09, persistency ratio going up across most buckets. Claim ratio is 99.20% group business and individual business 98.9%. International subsidiaries also benefited from growth in capital market and increased inflow, contributing profit of 189 crores compared to 76 crores previous year. Domestic mutual fund entities, both AMC and trustee company, saw increase in SIP inflow at YOY profitability marginally declined because last year we had a higher investment profit booked during FY23. With this, I hand over to Shanti for further discussion on the bank scale performance.
Thank you, Devang. I'll touch upon the business highlights. Overall, bank saw robust growth in its advances and deposits in Q4. Bank's customer assets grew 20% YOY and 6% during the quarter. There was good growth across all the segments, with the consumer bank growing at 20% YOY and 5% QOQ, commercial bank at 20% YOY and 7% QOQ. SME bank, credit institutes, grew at 19% YOY and 6% QOQ. Commercial bank book, as Devang said, includes the Sonata acquisition, which got consummated during. Let me talk about brief highlights on both assets and liabilities, and starting with the assets. Our mortgage lending business, which is both home loan and LAP on the consumer side, continues to grow well with a YOY growth of 6%. We've seen improvement in yields towards the end of Q4, and performance of the portfolio continues to be extremely robust and strong credit quality of the book. Our unsecured products, credit cards, personal business loans, showed good growth in Q4. Given the recent RBI directive, the focus on cards will be on servicing and nurturing our existing customers through on customer engagement and loyalty programs. Our focus on personal loans and business loans continue as is. Overall, risk metrics for the unsecured business continues to hold well. Early reads from new sourcing quite encouraging, and we have seen improvements in the quality. We continue to maintain a close watch on emerging risks and leverage build-up in the system, in addition to collections and resolution. On the business banking side, in consumer bank, secured working capital maintained momentum with a 20% growth YOY and 7% QOQ, largely powered by rebound and utilization by micro enterprise. Let me now turn to commercial assets. Commercial vehicles disbursement in the quarter 4 grew 5% YOY, outpacing the industry growth, helping us improve market share. This is an improvement, and we will continue to grow our book and market share in this segment. Collection efficiencies remain stable. Construction equipment, again, given the infrastructure spend, disbursements grew 47% YOY, where also we gained market share in the quarter. We expect to sustain growth momentum in the upcoming year. The tractor industry was muted, drop in growth for the year at 7.5%, while at Kotak, we were flat for the year on the growth side. It helped us also gain market share, and we continue to maintain our dominant position in the sector. The used tractor finance business in a strong growth the current year, and we intend to continue to focus and deepen our presence in Bharat. Some collection stress is visible in geographies where monsoon was erratic, but our collection efficiencies in Q4 were better than in the previous year. Microfinance. Our microfinance business has reported a healthy growth in advances of 31% YOY. With the acquisition of Sonata in March 2024, presence has now increased to 16 states through a network of 1,400 PCs, and we have a customer base of almost 57 lakh women borrowers. Sonata is now 100% of the bank and will act as a business correspondent by the microfinance business. Collection efficiency, again, like the tractor industry, in certain rain-deficient areas, were erratic. Overall position is stable. We are focused on integrating Sonata, the group, and strengthening our operations and making investments in technology for greater controls. Let me now turn to the wholesale bank. We saw strong credit offtake from almost all our segments across large corporates, multinational financial institutions, driven by higher NCD additions and deeper penetration. Real estate book saw strong dispersals in the last of the quarter. We remain bullish on this sector given the strong sales and collection and our activity to increase our business penetration across commercial and residential credit. The mid-market and SME, which is where we focused on, grew faster from the rest of the segments. In mid-market, on twice the number of customers this year as compared to last year. Majority of mid-market business focused on working capital-based businesses. SME also, we witnessed increase across key metrics, assets, fees, acquisition of entities, and witnessed a record number of entities during the year. We continue to see profitable lending opportunities in the infrastructure space selectively, which prominently weigh towards higher borrowers in certain sectors like renewables, roads, hospitality, and other allied sectors. Intense competition on pricing continues across large conglomerates as well as large corporates. Key growth was healthy in this quarter, driven mainly by our capital market and education business, where we had very good traction on a few large deals in infrastructure, real estate, and GFC. Overall, portfolio metrics remain excellent with negligible credit. Let me turn to liabilities. Deposits showed a robust growth overall at 20%, YOY and 9.9% QOQ. The consumer side, retail TD showed strong growth in active money, which, like Devang mentioned, on a YOY growth grew at over 100%. Bank energized its effort to integrate current and savings account into consumer asset customers, presenting a complete suite of banking products to our asset customers. Our savings showed 5% average growth quarter on a YOY, and current grew at 3% on the retail side. Some deposits showed a strong average growth of 35% quarter on a YOY basis. Wholesale liabilities, which is current account largely, grew even though custody flows renewed. This was an account of focusing on higher share of customer flows and transactions in the corporate segment. Our trade assets grew very well in this quarter, 3 quarter-on-quarter, driven by domestic. Digital offerings through FIN, offerings on tax remittances, showed good adoption rates, with a complete launch of new and scalable CMS platform in a robust scale at a customer experience. We have seen significant increase in market share of our capital market and IPO transactions on the escrow side, and our specialized processing teams enhanced focus on regulated compliance. Overall, deposit franchise has seen good growth, and our asset franchise has been healthy in growth. On the side, we have had a good traction on client acquisition, and customer AUM has grown by around 6%. I will now hand it over to Ramesh for taking us to the capital market segment. As Ashok has said, special focus this time on the capital market. Ramesh, over to you.
Shanti. Fiscal 2024 has been a strong year for our investment banking business. We were number one in the ECM in fiscal 2024, being led 13 IPOs and QIPs, and also playing significant origination role for the large downs, promoters, and financial sponsors. Some of the notable deals that we did in the equity space were the IPO of Mankind Pharma, QIP of Cholamandalam Finance, and secondary round to a large embassy, Mankind, 5-star, DM, amongst many others. Our advisory business also had a record year, the highest ever revenue. This is despite the fact that the overall M&A market is down in India on deal making about 58 in fiscal 2024. Some of the notable deals on the advisory and M&A side we did this year were the sale of Glenmark's API business to Nirma, Tata Consumer's acquisition of Capital Foods, and the $1 billion merger of Suven Pharma and Cohance, among others. We achieved revenue of about 403 crores, almost all of this in fees, translating to a growth of 53% over last year. Q4 was a record quarter for us at the investment bank, the revenue growth of 83% over last year. Strong performance, fiscal 24 were higher by 44% over last year. Profit before tax of 277 crore and a profit tax of 215 crore. Our time for fiscal 25 at this moment continues to be robust. I will now hand over to Shripal Shah, Kotak veteran, and who is just taken over as the MD and CEO of Kotak Securities.
Thank you, Ramesh. I am absolutely delighted to be here earning call for the first time and interact with you all. I'll be talking about the performance of Q4 and FY24 for Kotak Securities. For the Q4 FY24, our total income rose by 78% to rupees 1,216 crore, up from rupees 660 crore the corresponding quarter in FY23, primarily driven by substantial growth in cash volume in industry. For the entire FY24, total income is up by 30% at rupees 3,982 crore, from rupees 2,986 crore previous year. In terms of profit, for the Q4 of FY24, our profit after tax stood at 378 crore, which has more than doubled from rupees 152 crore in corresponding quarter in FY23. For full year FY24, that is up by 40% at rupees 1,266 crore versus rupees 860 crores for FY23. I'm happy to share that this is the highest ever profit by Securities in its history. So market share, we maintained our cash market share for FY24 at 10+%, while our derivative market share reached sharply to 12.6% from 9.2% in FY23. In the quarter, we enhanced our newly launched Neo platform with a host of new features and new products on it. It includes the introduction of Neo Mutual Fund platform, simplifying user journeys and enhancing accessibility. We also introduced InstaTrade to provide trade solutions by offering chart, option chain, returns, orders, and P&L all in one screen. Additionally, we launched our extra module to import placement journey and expedite application processing. We actually rolled out one of the best plan in the industry, a pricing plan called Trade Free Pro, which is offering very competitive pricing on margin trade facility products in terms of interest rates and delivery rates. This enhancement Neo remains preferred choice for our clients, accounting for nearly 86% of firms executed orders and 86% of new accounts opened in Q4. Our institutional equities business registered a stellar growth in revenues, maintaining its leadership position in both cash and derivative segments. Institutional equities continue to add new global and domestic clients to its franchise. It also showed very strong performance distribution of IPOs, QIPs, open offers, and execution of block trades, and maintain its leadership position. With this overview, I will now pass it over to Ashok for update. Thank you.
Thank you, Shripad. I hope you got a good sense of not only the quantitative aspects of our business, but also some of the qualitative aspects of our business, and of course, the spotlight on the capital markets. Let me move head on the RBI order. On April 4th, we received an order from the RBI directing us to stop, 1, onboarding of new customers through our online and mobile banking channels, and 2, issuing fresh credit cards. Needless to add, we take education from our regulator very seriously and have complied with the decisions with immediate effect. For the sake of complete clarity, we share that there is absolutely no impact on our existing customers across all channels. We've been seeking guidance from our regulators on resiliency technology platforms and on enhancing the experience for our customers. We are totally committed towards building world-class technology infrastructure and giving best-in-class customer experience. Consequently, for the immediate, we've stopped digital onboarding of new customers and fresh issuance of credit cards. This is primarily affected acquisitions in 811 and our credit card business. 2, develop a plan to mitigate the impact on businesses. The plan focuses on protecting our existing customer base and deepening relationships with them. 3, we are accelerating the execution of our technology and strategy to achieve resilience, appropriate capacity, and to meet regulatory cybersecurity standards. As you well know, we've been on this journey for the last 2-3 years. We have made a number of very senior hires, significantly augmented the internal tech team, and invested heavily in improving our customer reliance. Year on year, our tech spend has grown 30% and is now at over 10% of our total OPEX. However, our efforts have fallen short of the expectations of the regulator. This, in our view, is an account of, for one, that tech changes take time to pay out. And number two, demand is growing at an ever-increasing pace. These have therefore required us to step up our efforts on both fronts. In terms of the financial implications, as you're aware, for both 811 and credit cards, we have the J-curve impact in year one. This is obviously offset by the incremental tech spend. So while there is a loss in customer acquisition momentum, the overall financial implications are limited. We are in ongoing dialogue with the RBI on seeking their guidance in meeting the expected outcomes. If I can now ask you to set aside the RBI order, we'll check if you have any other questions on it, but just take a big step back and let's talk a little bit about where and how the management team wants to take the Kotak Group. It is not new news that the Indian economy is doing well and that the Indian economy is predicted to continue to do well over the next 5, 10, 12 end of years. That's not new news. The Kotak platform is very, very well positioned. That too is not really good new news. These are the strong tailwinds for us. It's also very, very clear that our number one priority is to get business as usual, as quickly as possible. But during this period, we also want to take a little bit of time and think strategically and think ahead. What are the things that we don't want to change at all? What is it that we want to tweak as we kind of go forward? There are two things that I'm very clear we are not going to change. It is in our DNA to deliver healthy returns with a well-calibrated risk appetite. This is not going to change. However, the market is evolving, things are changing very quickly, and therefore, from a perspective, as I look out into the Indian market, a couple of things strike me. Technology, as all of you know, is rapidly changing industry, changing the way we live, changing the way we communicate, the way we work, and stuff like that. But most importantly, technology is changing the customer. The customer's outlook, the customer's exposure, the customer's expectation are all changing. And for all the years that I've been in business, one thing that I have learned is that keeping the customer at the center of everything that we do and aligning the entire business model behind the customer is the only way to win. This technology change that I've been talking about and the impact on the customer not only restricted to India. Frankly, it's a worldwide phenomenon. But it has had maximum or a much greater impact in India because three things have kind of come together in India. The first thing that's happened is a tremendous amount of push by the public sector. How the government of India has built an unparalleled digital infrastructure. Two, the cost of telephony and data in India is about the cheapest compared to anywhere else in the world. And these two factors have therefore resulted in an adoption curve by the Indian consumer at an unprecedented level. With all of this, I therefore look at the Kotak Group. Our management team spent a lot of time over the last 90 days looking at how our strategy should evolve, and we've agreed to look at the whole business in terms of four lenses. Number one, customer, as referred to, that the exposure, outlook, affluence, expectation is changing. We have to gear up for this. This is the starting point. The rest of the business model will align behind this. We do have a lot of products and services within the group to meet the needs holistically of the customer. It's something that we do internally very well. Two, the colleague. Ultimately, we are a people business. The colleague is someone who comes as a customer and also represents delivery of our promise to the customer. We need to hire and retain the appropriate talent to transform our business in light of the changing customer experiences. And we'll work towards being regarded the employer of choice in financial services. Three, company. So customer, colleague, company. Company, three elements to it, bringing the power of all our businesses to meet the holistic needs of the customer. You may have seen, we have already created the position of one product to try and bring this to bear and bring the power of all our products to the advantage of the customer. Two, scale. Scale, not for size, but for relevance. Remember, we are not going to shift our focus away from returns. So this is not scale at the cost of returns. This is scale with returns. And three, we realize that the only way you achieve scale, that you achieve scale without compromising returns, technology will play a very significant role going forward. The fourth C, and to keep it easy, we put it into a 4C kind of framework. The fourth C is community. And here, it is all about re-establishing and reinforcing the Kotak brand and building very good relationship with all our regulators, of course the RBI, but all the other regulators that regulate us. These are the four lenses by which we are going to plot the future path of the Kotak Group. And you will hear the management team and I talk much more about these four C's going forward. For the time being, like I said, the immediate priority is to get the business as usual. Believe that other than these impacted businesses, the rest of the businesses should continue on the growth path. And we want to use this period to evolve all the businesses along the 4C lens, be ready and come out very strong when we get back to that business as usual. With that, I'd like to open up Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the telephone. If you wish to remove yourself from the queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue arises. From the line of Chintan Joshi from Autonomous. Please go ahead.
Hi. Thank you for letting me ask the question. Can I ask three, please? The first one is on the RBI actions. You have that there should not be a meaningful impact on growth. You explain to us why there should not be. If I recall all various stations of digital in every presentation and conversation as has been the case today. And if digital has been a strong onboarding driver, then there should be an impact. So help us understand why there should not be a material impact and what kind of impact should we expect. That's my first one.
You said you had three, right? You want to go with the three? You want me to answer
Yeah,
this
sure.
one?
Yeah. No, I can ask all of them. The second one is on the fourth point you mentioned about cycle. If I about underwriting has been extremely strong over a very long period, almost industry leading. But that comes with a sense of conservatism where, has not been ambitious enough to take market share, whereas private sector banks have. Can you comment on, are you committed to growing faster than the major private sector players? And I'm focusing on the private sector, not the system. And then the final question is the tail one. Could you give us a sense of how cost of funds and yields on loans have evolved in this quarter, and how the dynamics have evolved in this quarter?
Okay, thank you. So what I'll try and do is I'll try and answer the one on the impact of the RBI and the underwriting one, and if you don't mind, if you could have the one on cost of. Yes. Okay. So look, on the impact of the RBI order, let me kind of feel it out for you, right? One, what the order says is that all onboarding on mobile and digital channels, new customer onboarding is what the RBI has said that you should stop. And two, they've said that the credit cards should be stopped. Okay? Now, depending, of course, on how long it takes to get back to business as usual, that will have a major impact. If you say that on an annual kind of basis, the area which really gets impacted, or the two areas which really get impacted, are 811 and credit cards. Yes, we do a lot of other business digitally. It's not so much like in the corporate bank. We do a lot of stuff digitally. Customer wants to do cash management, or when the customer wants to do transactional banking. But that is an existing customer. The onboarding of the customer in either the private bank or the corporate bank or the commercial bank, a lot of it is not entirely digital. It actually involves a fair amount of assisted journeys or, where people are kind of involved. So, and also, we continue with digital journeys to existing customers. So an existing customer taking on a personal loan, or an existing 811 customer taking on a new fixed deposit. That is not affected. So the only thing that is affected is new customers in credit cards or new customers 811. Now, in both these businesses, as we've always been disclosing, credit cards, this is a worldwide phenomenon. In year one, there's a J curve. In year one, the cost of acquisition exceeds the revenue that you make. And therefore, in year one, in both these businesses, acquisition actually is a drag. Right? So in year one, you will actually have a financial benefit. Now, the offset this is going to be incremental technology spend. Obviously, like I said, our number one priority is to get back to business as usual. We're going to start our efforts to get back, and therefore I'm saying that if you take the offset of two, the impact is actually minimal. Now, what exactly that number will be is hard to tell. Back of the end, it's only been 7 days since we got the order, but back of the envelope math tell you somewhere between 300 to 450 crores number, right? Yeah, it's very back of the envelope. It has lots of assumptions baked in as to the timing. That's the way we're kind of thinking about it. Then I move to the underwriting side. On the underwriting side, look, I think right now, if you think about it, India's economy has been doing really, really well. Really well. Okay? If you look at what's happened in the industry and look at loss rates and stuff like that, post-COVID provisions, it's really been a Goldilocks period for the last 2-3 years, at least since COVID. Now, all of us know credits go through cycles. At this point in the cycle, to go out and get aggressive on credit, I don't think is a smart thing to do. We have always been prudent. We will continue to be prudent. We have continued to gain market share, but we will do it smartly. We are not going to go for a wholesale change in risk appetite. Not so early out, right? We will continue to grow the business. We will grow the business. We will seek to grow the business faster than competitors, right? We feel particularly good about our corporate business and the promised credit goals. We continue to do that. But right now, I'm not sure we feel comfortable about making a wholesale change in our risk appetite. Devang, you want to take the question on
Thanks, Ashok.
Yes.
Thanks. Before you go there, can I just come back on a couple of things? So in terms of employment growth and corporate one, mainly it's retail in the unsecured space. It should be like a number around drag. It's going to be like a 10% drag or a 5% drag on growth. Is there a quantifiable way we can out? And yeah.
I made it easy for you. I gave you a number.
I just want to add to what Ashok said. You asked for transactions. We always have said 50% customers comes through our mobile and net channels. They're all existing customers. Some deposits, a whole load of products are all existing customers. Credit cards will get impacted, but the impact is calculated in the number that Ashok has talked about, despite a J curve. Some small amount in personal loans, but that we will make up through, assisted as well as the journey that we have, because we can continue to sell around the branches and to our existing customers.
Okay. Coming to your question on cost of fund, the way we look at cost of fund, I think it is essentially three components. Basically the deposit mix, the duration of the deposit, I think the alternate source of funding. So if each of them, the deposit mix clearly with challenges in the low cost deposit of CA and SA is moving towards term. To address that, we introduced the innovative product, as you know, in May, which is the Active Money, which is a TD product, where the cost of deposit is marginally higher than SA, but lower than the TD. In terms of the deposit duration, most of the deposits have priced over last year. And on the alternate source of funding to fuel our growth, they're obviously actively pursuing finance as well as infrastructure bond financing. All put this together, yes, cost of fund will move up. However, it will not be at the same pace and will be far gradual than the rise what we saw during the current year. Thank you.
Too on interest rates is reasonably stable. We've seen deposit rates stabilized over the last few months. We'll have to see how it goes from a demand supply as well as external rate movement perspective.
Thank you.
Thank you. Ladies and gentlemen, in order that the man is able to address questions from all participants in the queue, we request you to please restrict questions to 2 per participant. The question is from the line of Kunal Shah from Citigroup. Please go ahead.
Yeah. So sorry, just to clarify this 300-500 crores of impact which you had said, that is on what? It was. Hello?
Kunal, CBT.
CBT impact 300-500 crores. So,
That's correct.
For the year.
This is assuming annual.
This is annual.
So we'll try to resolve and hear you much earlier.
Okay, sure. Broadly, this takes into account maybe the overall population on the unsecured side. That's there. In terms of guidance, which has always been like being unsecured towards mid-teen in odd sense. Now, how do we see that the near future? Secondly, in terms of branch expansion, maybe we still have been highlighting that we want to go more digitally than the physical branches. with this kind of restriction, is there a change in a way we would be approaching the expansion plan?
Yeah. Hi. To take the question on the unsecured loans, I think our trajectory remains same. Continue to aspire for mid-teens as we have committed. And as you know, unsecured loan consists not only credit card, but also includes personal loans, retail microfinance with this acquisition of Sonata and the growth microfinance, obvious, and business loan. All of that are included. So our aspiration and target towards achieving mid-teens continues. On the bank side, I will request Virat to respond.
Look, in terms of network expansion, yes, for last 2 years, last year we did close to around 100 branches. Even this year we are scheduled to do more than around 150 branches. From that perspective, I think we believe network will expand. We will gradually expand the network as we go forward. We also will look at it and evaluate as we go forward. But as far as expansion of the branch network is concerned, we will continue to expand as we go forward.
Our aim, just to add to what Ashok said, the number one priority is to see
product mix on the asset side of the balance sheet, right? So even our compared to the competitors, that's what determines how well we are covered. To Devang's point, we feel, and given all our history, you can back 2.5 years, we have been always quite conservative on risk appetite. Was conservative. That's one thing that I don't want to change, like I mentioned. So under all those kind of circumstances, and given the mix, we feel very comfortable on that score. Let me pick up a little bit on the tech side. On the tech side, that number that I quoted, somewhere between 300 and 450, all of that is not tech. Tech is going to be an integral part of the business, no doubt. And tech, we've been expenditure. Now, we've been spending about 10% of our OPEX in tech. So as the base of expenses go up, tech expenses go up. So last year it was 300 crores, round numbers. This year 1,700 crores. We're going to expect to see similar amounts of growth in tech, right? This year, some piece, and honestly, I'm not able to tell you exactly how much the 300 to 450 is, because we are still finalizing what is the scope of work done. Look, it's only been 8 days since we got the RBI order. So trying to finalize what elements of that tech we're going to accelerate, bring forward, is work in progress. But tech is going to be a very important ingredient for our business, and at about 10% of OPEX is what our tech expenditure will be.
Thank you. Thank you. Ladies and gentlemen, we request you to please restrict your questions to one question. You may rejoin the queue if you have follow-up questions. This question comes from the line of Harsh Shah from Goldman Sachs. Go ahead.
Yeah, hi. Good evening. This is Rahul Chen from Goldman Sachs. Hello to everyone. Actually, if you permit, I may like to ask questions. One is, so you laid out your thoughts about how you would like to bank forward from the lens of 4Cs, if I heard it right. Just to also talk about the quantitative figures, what milestones do you set up for yourself or like us to think about in terms of profitability and growth? Particularly in growth, given that the bank is just about 1.5% market share, got huge opportunities ahead of itself, and has been investing top dollar in digital, as you articulated. Brick and mortar, we feel that could have been done a lot more. So just want to understand, first on what milestones, should we perhaps judge your tenor from here on across the growth, profitability, and asset quality? I have more question after.
So Rahul, you're a tough taskmaster. I've just been in the job for 100 days. But anyway, apart from that, look, we've hit a step, okay? And like I said, our first task is to get business as usual. Once we get to business as usual, there's really no reason why we shouldn't to grow at least as much as we've been kind of consistently growing over a period of time. Now, I've also told you, and I'm very, very committed to that scale is important to us, right? And how we're going to scale those businesses and get, not have fractional market shares, but go significant to something more relevant in terms of market shares is going to be critical. But the first priority is to get business as usual. Once we get to business as usual, we will get more aggressive on the kind of growth target.
Got it. And just related question to that is, what profit pools are you more excited about? If I were to simplify this in consumer retail and commercial retail, consumer retail is, people like, individuals would borrow for consumption needs like home loans, versus commercial retail, where the has been historically very successful. So segments of growth you would want to go after, given you also make the remark that you're not very comfortable about pressing accelerator given the environment we are in. So what specific, talking about?
Yeah. So Rahul, what I said was that I don't want a drastic change in my risk appetite. Okay. Am I excited about the consumer bank overall? I'm very excited about the consumer bank. Am I excited about our private bank? I'm very excited about our private bank business. The capital markets business, Ramesh just took through it, right? That's doing really, really well. Institutional equity is doing really, really well. Kotak securities, really, really well. Corporate bank, really nicely poised to kind of grow. Tractor finance, we've got a great kind of market share. All of these businesses where we've got well-established platforms and we've got well-established processes, those are the areas where we will push the accelerator and grow quite aggressively. Kind of focus on those areas and really grow. SME is another area where, I think we can get significant amounts of growth. We've got over a period of time, obviously this whole RBI order has consumed a lot of management bandwidth. But over a period of time, come back and say, like, for these segments, what is our proposition and how are we going to go after these propositions in a pretty big way?
Right. The second question was on human capital. We've, of course, been seeing and hearing about, a lot of changes that have taken place at the senior level and management level. What kind of growth opportunity you're talking about, how well placed you are, how far you are from adequately staffing the bank. And of course, you had one high profile departure also. Would that have on the bank's performance, or you've got the bench already up to, get the opportunities?
Yeah, so Rahul, look, of course, the press plays up kind of pictures, but nobody takes into account that, we can have a strong bench strength, right? Today you've heard Devang. Devang has been groomed chairman, taken over. He's the group CEO, CFO. Shishpal, he's kind of, taken over Kotak Securities as the CEO and kind of, Pradeep has moved into a new role, right? And look, Manian is a friend of the firm. Manian was with Kotak for 29 years. Manian has played a very critical role in building out of Kotak. Yes, he has some aspirations. He wants to go and do things in other parts of financial services. That's absolutely fine, right? We sincerely wish Manian the very best. I obviously haven't worked so closely with him, but in the months that I worked with him, I really enjoyed working with him. I sincerely wish him the best. My colleagues around the table, of course, know him much better, and they too sincerely wish him the very best. These things will evolve over a period of time. There will be people who will retire. There will be people who will choose to do different things. The good news is that for the most part, we have the bench strength, right? Even with Manian walking away. We've got, Aishwarya, Paritosh, Manish, Ramesh, all of them kind of just picking up into those roles. And, once you get to meet them, you see the bench and the depth on the bench. So I feel very comfortable with that. There will be certain areas where we'll have to, adapt new talent. Things change. I think that's a natural course of business. And frankly, honestly, with the kind of team I'm sitting with today, am I losing sleep over this? The answer is no.
Got it. Very helpful. Just one last question on unsecured loans. So we have got seen slippages increase, through the course of this year. And this quarter also, it is sort of, further pushed up. But it's not very dramatic. But still, I wanted to ask you, how far are we from normalization in the unsecured, at risk? Is there some more way to go? I mean, the slippages will further inch up from here, or we are kind of near where normalized, run rate should be?
See, you said unsecured, basically the losses there have increased, and are we normalizing and so on, okay?
Yeah.
What I like to emphasize is that we are very comfortable in terms of our positioning vis-a-vis unsecured. Okay? It's not that our credit losses are beyond our risk appetite, or we are beyond what we've seen in the past, or there is something to worry about. Okay? So overall we are comfortable. The position as we see it in terms of delinquencies, early delinquencies, all of that is looking perfect. Okay. And we are very watchful because, as Ashok had said initially, we've been through an extremely benign credit period. So one has to be extremely watchful of this portfolio, but currently we are very, very comfortable.
Got it. And is there any impact of Sonata acquisition across numbers, meaningful impact on the numbers from Sonata acquisition across the line items? And if you can quantify that on...
Sure. So I think Sonata acquisition was done in the last of March. So no meaningful impact in the numbers. But as I said, as we go forward, it will happen.
All right. Thank you so much, and thanks for being so generous with the time.
Thank you, Rahul.
Thank you, Shanti.
Ladies and gentlemen, at this point, we request you to please restrict your question to one question per participant. The next question is from the line of Roshan from ICICI Prudential Mutual Fund. Please go ahead.
Thanks for taking my question. Essentially, want to understand the IT spending a little more. How much of it is and how much of it is variable? That is my one question around this. And then, if I look at 1,300, coming 1,700, right, assuming BAU 20% growth to the IT spending, we're talking about something like 400 crores of growth in natural course of the year, right? But of it, because the other businesses, 7 and the card business, are going to have, we are going to have savings out there. Are we going to spend more like 400, 500 crores on top of this 400 crores of growth we are talking about as a BAU?
So, let me try and answer this question, okay? It's very hard at the moment I had to tell you how much is variable, how much is fixed and stuff like that, right? Because there are certain products where we have outside vendors. So, for example, credit cards. We run credit cards on Vision Plus. Vision Plus is an international kind of platform. The kind of deal we have with Vision Plus, per account we pay them a certain amount of fee. That's one example in cards, right? Obviously, when the processor is house, like let's Nickel, on we run the whole liabilities business or the corporate business, or some aspects of the commercial business, or 811. There it is more in relation in the nature of a fixed cost, right? So, and then of course, the added complication is that how much you spend, how much of it gets capitalized versus how much gets expensed. So, really getting into that kind of level of detail, I don't think it's going to be very helpful for anyone. The point is total tech spend is roughly 10% of OpEx, right? And that percentage is, for the most part, round numbers, staying there. It could be 9.6, 9.8, 10.5, 10.6 kind of thing. 2 years ago, that was roughly 1,300 crores. Last year, it was 1,300 crores. So as the OpEx base grows, the tech spend will grow. Tech spend is not going to go away. Tech spend is not going to go down. Tech is going to be a competitive advantage, and it will continue, and we will continue to invest such that we get to the risk resilience and capacity. Now, within tech spend, the time being, the tweak will be more towards risk resilience and capacity as opposed to coming up with new products or new features or a new mobile banking app and stuff like that, right? So within tech spend, it will be more on risk resilience and capacity as opposed to new features and things like that. Sorry, I lost my train of thought on your, what was your question on 811?
Sure. So repeat this. So what I was trying to allude to is, you're talking about an 350 to 400 crores on PBT, right? Now,
yes,
there are clearly positive cost savings from 11 and the credit card, which means the spending is going to go up by more than crores, right? That's logical.
No. See, look, I said the total estimate is somewhere between 300 to 450 crores. On the positive side of the column, you're right, acquisition costs for 811 and credit card on an annualized basis will be a positive. You're right that the negative will come offset of technology spend. But in a business like credit cards, even existing customers, right, spend, what happens to the spend, what happens to the revolve, what happens to, keeping the teams in place in all other areas. There are other expenditures as well. The balancing figure is not entirely technology spend. There will be some increment technology spend. That will not account for the total amount of 400 crores. It will be far less than that.
Understood. Yes. Okay. Thanks.
Thank you.
Thank you. The next question is from the line of Sheikh Murarka from HSBC. Please go ahead.
Yeah, hi, good evening, and thanks for taking the question. So I just want about customer acquisition you were doing through 811. And when I look at your numbers from last year, FY23 you acquired 6.5 million customers. FY24 you acquired around 8.8, and about 75% of these would have through 811. Now you can't add 50 lakh customer base that you were getting, and now you're not going to be able to get it. So you look to continue to acquire as many of those as possible. That's point one. Point two, to attack them, will you have to increase your term deposit rates more than competition? Or, when transactions are going to branches for onboarding, will you have to staff your branches with more people, and will this push up OpEx? So that's what I wanted to understand around the customer acquisition that you will, foregoing by not having this 811 for something.
Shant, do you mind taking the 811 and maybe cover the TD rates issues as well?
Yeah, that's right. So as far as 811 is concerned, as we said, we were acquiring a lot of customers. Now, what we will do is that digital onboarding is not possible. Wherever we still have a stock of what you call OTP accounts to convert KYC accounts, which we will continue to do. We will have to stop our acquisition till such time we come back. What we will do is we have about 2.5 crores of existing 811 customers. Of course, we were acquiring so aggressively. Our cross-sell ratio still remains small because of the denominator impact. So we're going to focus on 3 things. Increase the deepening of base. Second, set our journeys when we come back, so that on the product we've launched a new app, as you may have seen, and there's still a lot to be done on that, and get ready for when we come back. The impact will not be on this year because we'll actually have a saving on the acquisition cost. Impact on some of it could come in the following year of customer acquisition as we look at it. Yeah. We've done the math, and it is part of what Ashok talked about in terms of the number that he talked about. In fact, but we will do a number of things to transform through while we wait for the green signal to come. Branch acquisition channel will continue. The digitally assisted channels branch users will continue, which is more through tabs and biometric, etc. And 811 will continue the strategy of waiting and completing the FY2023. And as far as term deposits is concerned, it actually any of this is going to trigger the term deposit ratio. Right now, if you saw in the last from February 15th onwards, the system has been reasonably liquid. Deposit rates have been reasonably stable. I think everybody is waiting to see how the Fed moves and how inflation moves. We see deposit rates reasonably stable. I think domestically, demand side is what going to really, drive the hits. Right now, we see more stability, but we'll have to wait.
Shanti, just quick follow-up. Would you have in the capacity of branches, because more of transactions will now have to be executed at branch rather than on the app or on the mobile app?
Existing customers, there is no restriction for execution of transactions on the mobile. Whether it's our branch customers, whether it's 811 customers, they need to do their payments, their term deposits, buy a personal loan, everything through the mobile and net channels, even if they don't have branches for any of their services.
No, sure. But this is the new customer. So new customer onboarding will have to be done at branches. So will you have to raise it for that?
No, we have a field sales force for 811 who will take care of the new customer. Our number of customer acquisition will slow down. We were doing it digital, direct DIY journey. It is not permitted. So the number of customers we will acquire in 811 will go down, right? Will be handled whatever we need by the field sales for the customer. Currently have.
Yeah, so Abhishek, put a different way, 811 acquisitions, to Shanti's point, will come down. The focus is going to be on deepening the relationship. If we are able to do the deepening of the relationship and be able to do it beautiful customer journey, can you imagine how powerful that becomes when we get back to business as usual, right? That would be a massive kick-up for the entire franchise. Therefore, we are spending a lot of time on saying, okay, let's get that journey right.
Sure. And so this does not lead to any kind of slowdown in deposit growth in the medium term or in the near term
at all.
Marginal, yeah.
Got it. Thank you so much for that clarification. And all the
thanks, Abhishek.
The next question is from the line of Saurabh Kumar from JP Morgan. Go ahead.
I just wanted to confirm one number. Your growth for next year should broadly be similar, your percent, and your incremental deposit accretion for next year would actually not be that high versus this year, right? These are the thousand points.
We're not doing any forward guidance.
Yeah. So I think we need to understand the number of customer and growth value. I think what we are all saying is the 811, while the number of counts is significantly high, in terms of the value, it doesn't contribute significantly or materially on the value side. So yes, while there will be a customer acquisition count at 811, I think to meet the funding requirement of the balance sheet, we will have enough avenues, the alternate source of deposits from the alternate customers and borrowing channels.
So I was talking more from total customer assets. You've grown percent, that's 100 points over here. Would you be still confident of achieving that?
Yes. As we have maintained that we always aspire to be 1.5 to 2 times the nominal of the GDP growth.
Yeah.
We need to grow that.
Okay. Thank you.
Thank you. Ladies and gentlemen, we will take this as our last question for today. I would now like to hand the conference over to Mr. Ashok Vaswani for his closing comments. Over to you, sir.
So, first of all, thank you so much. It's been, it's a long evening. It's already well past 7 o'clock. So, truly appreciate your time with us. As a management team, I said we are totally committed to getting back to business as usual, take whatever it needs to do. We will isolate the other businesses and put them on the growth trajectory they've been. As far as the businesses which have been deeply affected, which is or have been affected, 811 and credit card, developing mitigation plans. And we're going to use this period to really think about how, when we come back to business as usual, we come back soaring ahead. I look forward to obviously keeping you all posted on developments. And thank you very much for joining us this evening.